This is 7th Swedbank Economic Forum, but the first one which is online. Other than that, everything is expected to be the same. My name is Nerijus Mačiulis. I'm Chief Economist at Swedbank Lithuania, but I will not be alone here today. My colleagues from Sweden, Norway, Finland, Latvia will join us today and will present the most relevant, important topics, forecasts and views that are that should be most important for you. Those who have participated in Swedbank Economic Forum in the past, you should know that not only we present our most recent forecast and view what is expected in the coming months, but also try to look in a more distant future, what kind of structural changes and challenges we see ahead of us. So today I will be moderating this forum, but I will start with brief introduction on what can we expect and what risks can we expect in years ahead. I will remind you that you have the opportunity to ask a question. You can see that on your screen. And we, all the Swedbank economists from Nordic and Baltic countries, will address these questions at the end of our presentations. The presentations themselves will be brief and concentrated and will cover most relevant issues that are happening around the world and also in Nordic and Baltic countries. I will introduce my colleagues shortly, but before that I would like to start with a short presentation on the new global disorder. This is how I call this presentation. For some it may look like the new desirable order. For some it is a disorder. And in 2020 it would be strange not to start from the virus, from the novel coronavirus that we have all stumbled upon this year. And our assumption when we made the most recent forecast is that in this front the worst is behind us and we will see more waves. We have seen the large second wave in the United States. We are currently seeing a large number of new infections in Spain, UK. Also a little bit increased number of new infections in Baltic countries. But how this second wave and future possible waves are different from the first one that we have seen in March and April is that it seems that they are much less dangerous, at least until now. And you can see that, for example, patients with COVID-19 in intensive care, we had quite a lot of them in all countries during the first wave in March and April. This was a very dire situation. Also, death rates were quite high. But now, in all of the countries where we see the second wave, number of patients in intensive care has declined and is close to zero. Death rates are also close to zero. And it's not completely clear why is that the case. It's possible that people are being careful, so they are exposed to smaller doses of the virus, and then their T-cell immunity helps them to avoid bigger instances of COVID-19. Now, another reason could be related to the fact that healthcare institutions are better prepared. There is medicine that helps to avoid the most disastrous consequences. Also, there are at least 6 mutations of the SARS-CoV-2 virus that are known. So it is possible that virus is becoming just another coronavirus to which we are going to be exposed. So our main assumption is that by the middle of next year, the worst of it is going to be over one way or another. With the help of medicine, vaccines, or natural retreat of the virus, we will not have to worry too much about it. But even now, I think the second wave and the future waves that we're going to probably see is not the biggest threat to the global economy and our local economies. We see a lot of interesting structural shifts that are taking place around the world. And in the presentations from my colleagues, you will see that a lot of countries have embarked on quite aggressive fiscal stimulus and monetary stimulus. Governments were borrowing a lot and spending a lot to mitigate the worst possible consequences of the pandemic and lockdowns. So the amount of the global debt is likely to explode this year to close to 300% of GDP, like never before. And that is going to continue in the future. And if you look at the, for example, US budget deficit, its projections for the next 10, 20 years, there are no plans whatsoever to stop spending and to cut deficits and to balance income and spending. So it is possible that we see a new normality where budget deficits, large budget deficits, and excessive government borrowing is accepted as normal, accepted as a appropriate government policy. And if countries are unable to borrow in financial markets, then of course they have a lender of last resort, their central banks. And central banks have embarked on money printing never seen before. And during the past few months, they have expanded money supply by trillions, by a few trillions in euro area and in United States. And they are likely to do that in the future as well. In itself, that would seem like an appropriate policy. But combined with the fact that governments are spending very aggressively, and central banks are printing money very aggressively, we see again a new normal. This was not the case in the past where central banks have collaborated so closely with the governments when it comes to economic stimulus. Yes, 2020 is a bit unusual year, but what I think is going to happen in the future that for many governments it's going to be very difficult to backpedal and step away from these very, very expansionary fiscal policies. Now that the governments see that they can solve a lot of social, economic, humanitarian problems by printing and spending money, how are they going to move away from that in 2022, for example? So this is going to be one of the challenges. Another challenge is, of course, that with this monetary and fiscal policy, it's going to be it's likely that it's going to have some inflationary pressures. On top of that, another thing that has become obvious during the past few years or even a couple of decades is increasing income inequality and wealth inequality. And the consequence of that we already have seen during the past 5 years: more protectionism, more nationalism, more populism. All that is leading to, or potentially may lead to, deglobalization. And why inflation during the past 20, 30 years has been very low in developed countries is because we have been living in the era of globalization. Things were produced where it is most efficient and cheapest to produce. We see international trade as a share of GDP expanded from 20% of GDP to 60% of GDP. That may be over. And even before COVID-19 crisis, we saw a strong protectionism stemming from the United States, not only against China, but also against neighbor countries, against European Union, willingness to bring back jobs home, to bring back production also home. So this is in itself, of course, can create shrinking global trade, higher costs, and larger inflation. And now, another factor that has kept the prices down all around the world during the past years was the fact that 1 billion of cheap labor has entered the market, and global production and globalization from Asia during the past 20 years or so. That is also changing. China is starting to age, and next to the globalization and protectionism, that also is going to increase costs. So we are used to, or developed countries are used to lower inflation, and that may be changing now. This is one of the risks that we should be aware of. And it's not a common understanding and common forecast now. There are disagreements if inflation is a threat, and even among us economists at Swedbank, we discuss this a lot because there are also counterfactuals like technological change that could keep a lid of prices getting out of control. But this is one of the risks that we should be wary of. Other risks, we will discuss this today, and I invite now my colleague from Sweden, Andreas, who is acting global chief economist at Swedbank, and he will present our forecast, our global forecast, what is expected from United States, what do we see in China, what are the major risks that keep him awake. Andreas, are you with us? Hi, nice to see you. So, the floor is yours. Please enlighten us. How do you see most important economic developments around the world?
So, unfortunately, I can't really hear you, Nerijus. I had problems with the sound transmitting over the Baltic Sea. Which is a bit of a problematic. So I don't know either if you can hear me, actually. If you could say that, you give me a thumbs up, so I will continue with my presentation. Otherwise, yes. So thanks for having me on, Nerijus. As I said before, I don't know if you're registered, but I had problems hearing you, so I don't know. But I guess I'm supposed to start here. Kicking off my presentation of the economic outlook. Now, you started on with our big economic topics, the really long-term structural issues. I will focus on the more short-term topics and our forecast, which was published 3 weeks ago. And it is, I will talk more about the global outlook, and then Heidi after me will continue with the European outlook. So if we start globally, I would summarize the forecast by this. So it is no doubt that the recovery is ongoing. We have seen that actually since, I would say, April. It is quite of a clear recovery in Europe at large, in most countries, also in the US, actually in most countries where you look. Now, this recovery is still fragile. I think you mentioned that topic before, Nerijus. One of the uncertainties still facing us are the spread of the COVID-19. And I think this, if we call it the second wave, the increased contamination now we see in Europe, in many countries, that is still a big uncertainty if, of course, countries again would choose to lock down their societies. Now, that is not really our forecast. We think this will be contained and that the recovery could continue. My second key takeaway would be that it is quite extraordinary times we're living in, and it is actually an unprecedented expansionary policy, both from the fiscal and monetary side, that we will see not only this year, but most likely also next year and in 2022. So, where are we? For those of you who like numbers, I will just give you the GDP forecast as well. As I mentioned before, we don't really foresee that this second wave of contamination that we now see in Europe, that will have any major implications for the economic outlook. We do, however, see that we will have a kind of a slow recovery, modest recovery for the second half of the year due to the still lasting restrictions and a continued uncertainty which will hold back investments and consumption. But then, as from next year, probably quite early next year, I would say, we will see a much faster recovery once this uncertainty goes away, and a combination with the very expansionary policy will actually lead to very strong GDP numbers and also improvements on labor market in general. We released this forecast 3 weeks ago. Before that, we had a forecast in May, and you see the comparisons here. It's quite small revisions, actually, to be honest, from our view back in May. We actually lifted the US forecast a bit, also the Chinese forecast and the global economic outlook this year. It's still massive drops in GDP this year, but note also that when we're looking into the next year, things will actually recover quite swiftly, and we will see growth pace both next year and in 2022 that is higher than potential. Then, talking more about the most important country in the world still, if you look at the economy, that's you. Then one striking thing is, of course, the recovery that we've seen in stock prices. It was a very, very short downturn. It lasted from late February to late March, about 1 month, and then since that time we've seen quite a solid recovery, although in the most recent days actually we have seen some downturns. Especially here, this is S&P 500, the yellow line, and then it's Nasdaq Composite, which is more heavy on technical industries. And if you look at that more technical one, it's actually up 20% since we started this year, while the broader index S&P 500 is roughly unchanged over there. And that is quite impressive given the fact that this is an unprecedented sharp downturn in the real economy. And although we're seeing quite a strong recovery in most cases, it's still not, we're not out of the woods. This is US employment rate, so that is number of employed as a share of population. And as you can see, this was a sharp drop back in March, April. Then we've seen some recovery. We're almost halfway back, but still quite far from the pre-crisis level. So if you look at the real economy in general, and especially the labor market, we're not back at pre-crisis level. But that is, so does this make sense, these stock prices? Well, what's really driving this, as you know, probably is the very expansionary measures taken from central banks. And the most important central bank in the world is the Fed. And the most interesting thing that has happened so far this autumn, I would say, is that the Federal Reserve actually has changed its inflation target. You could say this is a small thing, that they changed the inflation target from aiming at 2% to aiming at, on average, 2%. Now, I try to illustrate this, that this is actually not a small thing by this chart that you see. And this is not inflation, then it's actually the price level. So the yellow line is what would have happened if Fed has managed to each year exactly reach 2% inflation. Well, then we would follow the price development according to the yellow line. But in actual terms, over the past 10 years, the Fed has failed. It has undershot its target. It's not super much. And this is a phenomenon that was seen also in European countries. The ECB has also undershot the target, the Riksbank in Sweden, etc. So we're actually short of the target then if you look at price level. And the thing is now that the current new target, that is actually, that has a memory. So the policy from the Fed should be to compensate for this shortage, and actually looking forward then actually trying to overshoot 2% inflation to get back on the yellow track, so to speak. And this is just an example of how it could look like. Say that they have this shortage over the past 10 years and they decide to, over the next 5 years, they would like to close this gap. Then they would need to go for 3.5% inflation each year. And given the difficulties to actually reach inflation only at 2%, I think this is a huge challenge in the short run. We could talk about that later in the panel if really we will see inflation picking up, perhaps more sustained later on. But I think in the short term, at least, it is very much a downward pressure on inflation, and it will be quite a challenge for the Fed to reach their target. And what could it possibly do? I mean, they're doing a lot. They have cut interest rates to zero. They're buying a lot of bonds, almost everything. So they could, of course, do like a forward guidance. They could promise to keep the interest rates lower for even longer. They could buy even more to expand the so-called QE program. But in essence, their toolbox is starting to scrambling a bit empty, to be honest. But that is an important thing that they actually did a few weeks back. And I think this is a signal that central banks, how crazy it might seem, the big central banks, ECB and the Fed, they are still very much leaning on the inflation target. It is not that they are discussing financial instability and this kind of focus leaning against the wind. That is not the focus for the moment. It is very much still inflation targeting. Now, speaking on the US, sorry, I jumped one ahead. It is one interesting thing, of course, during this autumn will be the presidential election. In our forecast, we assume that Biden will win the presidency, and that is an assumption based very much on the opinion polls that we've seen. So far, his lead has been quite solid. Of course, this is a big uncertainty still, so it's certainly not for sure. However, I wouldn't call this presidency as a super important thing for our economic outlook in the shorter run in 2021 and 2022. I think we will end up roughly with the same figures, be it Biden or be it Trump. But of course, it could in the longer run, or it probably will in the longer run, be super important to win here. And also, of course, it could be very important for financial markets in the short run. I think for financial markets, and perhaps my colleague Øystein in Oslo will come back to that later on, but I think what financial markets really don't like is uncertainty. So I think regardless who wins in November, I think if there is an uncertainty, for example, if Biden will win with a narrow margin and Trump will question that call and they will have to calculate the votes and it will be a dragged process before we will actually have a result. That's a quite plausible assumption. Then we will see a risk-off environment which could hit equity prices and bond markets as well. So a clear result would be the best thing, I think, for financial markets. Then speaking on fiscal policy, it is going to be huge in most countries. Fascinatingly enough, it is not so that those countries with presumably highest or best fiscal space, that is the countries with low initial public debt, they have not actually spent more during this crisis. And that you could perhaps expect. But it seems, according to this chart, at least here you have on the y-axis public debt in 2019, and on the x-axis you have fiscal measures taken so far this year, according to the IMF. It's actually rather a positive relationship here. So actually the countries with the high public debt in the beginning, they actually tend to spend more. And most notably, as you can see from this chart, the US and Japan are the big spenders, and they have also the countries with large public debt initially. Now, this is, of course, a very early estimate. I think we will see huge stimulus coming up also for next year. So it will be interesting to see if this will change, including also the measures for next year. I doubt that, actually. I still think that the countries that has managed before to spend a lot will do that also going forward. And the reason why they could do that, again, is actually that central banks will be there to support them by holding down interest rates. One thing that we have not seen that much of yet is the so-called green economic recovery. That has been a big topic, a lot to talk about that in Europe. So far, however, if we look at the actual numbers, this is according to Bloomberg estimate, they included 50 countries, and of the total stimulus so far this year, the COVID-19 stimulus you could call them, only 0.2% are actually green ones. So, and actually in the chart here you can see that it's rather much brown stimulus so far. I'm not super surprised by this relationship. I think in the short run, in the first acute phase of the crisis, it's somehow natural that governments tend to do measures actually prevent employment to fall too much or really protect the economy short term. Would, however, expect that looking forward for next year, this will change quite a lot, and we will see much more green measures coming out. And that is also the signal from the European Commission and this EU deal that was agreed upon earlier this year. Okay, I will soon finish. Before I let Heidi in with the European outlook, I will just say a few words on China, which has been surprisingly resilient during this crisis. Here you can see exports compared to the US, and as you can see, exports didn't really take a hit at all in China. This is very much due to that they have managed to compensate the fall in some sectors with a big pickup in exports of medical supplies, but also home electronics, for example, has continued to sell quite well. And compared that, for example, to the US, where we see a drop in export by actually 30% so far this year. That's quite a difference. But it's not only exports in China that has done well, it's actually also domestic demand. And one such thing, a classical stimulus measure you could say from China is infrastructure investments. And there we could see actually a sharp drop earlier this year, but then a solid pickup, quick pickup later. And if we go back and look at the financial crisis, you could see that that was also kind of a policy that they did back then. Actually, infrastructure investments then in 2009 increasing by 40% or something like that year on year, which is super high. So that is the reason why China has managed so well. So I will stop there. I'll just say the summary again. The recovery is ongoing. It's quite clear. It's fragile still, but not that fragile as I saw just, I would say, 3-4 weeks ago. A bit more solid footing now. Also, we can't stress this enough. You know, it will be a super expensive monetary and fiscal policy for the next few years. And with all its implications, it's special and interesting times we're living in. So with that said, I'm back to you, Nerijus.
Okay. Thank you, Andreas, for your presentation on US mainly and China. I would like to invite now Heidi, our chief economist in Finland, who will move on closer to our home markets, Euro area. Euro area has been actually not very healthy even before the pandemic and has witnessed a decade full of crisis and full of problems. So this pandemic is nothing to be happy about and has even worsened the economic situation in a lot of countries. So Heidi will help us to see if there's anything to be optimistic about when we look into Euro area, which is of course one of the most important export markets for Latvia, Lithuania, actually all Baltic and Nordic countries. Heidi?
Hello. How are you, Nerijus?
I'm fine, thank you.
Yes. Okay, so over to the Nordic and the Baltics. not Baltics, Nordic and the Euro area. Let's wait for the material to come up. No material? Then I'm going to talk without material. Okay, so I've been asked to talk about the health and prospects of the Euro area and the Nordic economies, and I see myself as rather fit to talk about these topics since I'm from Finland, the only Nordic country being a member of the Euro area. We're going to start with looking a little bit back and then look forward, and a lot forward. The Euro area has had a tough year, and as Nerijus said, a tough decade. Here's a picture of GDP effects of the pandemic. It's China to the right, then US and the Euro area. And from this picture, you can see that the Euro area has been harder hit than the other big economic areas in the world. And the problems aren't over. But as always, when it comes to the Euro area, there's not one story. There are dozens of stories. And here's the same picture, but for certain Euro area countries. So you can see on the right-hand side, there's Lithuania, Finland, Latvia, the countries that have suffered less than average from the pandemic, economically speaking. And then to the left, you can see Spain, France, Italy, the countries that have been hit hardest. And this is, of course, always the situation in the Euro area. Different regions react in different ways. The important question here is, of course, why is it so that the Baltics and the Nordics appear to have suffered less than Southern Europe? And the first usual suspect is that the virus just attacked these countries more. Their lockdowns were much heavier, and their industrial structure is different. And tourism can't be forgotten. Spain and Italy and France are big tourist destinations, while we're here up north are not that popular to visit. So it's basically a tale of both bad policy and bad luck. And we can be happy about our own position here up north, because it also appears that we have been partly lucky, but we shouldn't be too content about that. But what's, I would say, amazing, and both Nerijus and Andreas have already touched upon that, and I actually have the same picture Nerijus presented earlier, is the policy response that we've seen in Europe during this pandemic. It's monetary policy, here are the central bank balance sheets, but it's also fiscal policy. And what I'm a bit worried about is actually, even though Andreas said that central banks still have a strong focus on inflation targeting and price stability, that is the case, but we're also seeing a strong dependence developing between fiscal authorities and monetary authorities, and that is especially problematic in the Euro area, where we have so many fiscal authorities. And it's looks as if that will be one of the big legacies of this crisis, that central banks are moving closer to fiscal authorities, and there is this implicit link that central banks keep promising to buy up public debt that governments are making policy about. So that is one of the potential big shifts and legacies of this pandemic on the policy side. But there are other big issues, and one is, of course, what is happening to EU. EU policymakers decided on a big support package this summer. That was maybe a big surprise that such a decision could be reached, and that was already a victory. But as I see it, the important question is not how much is who getting. Here's a picture where we're grasped that how much is actually going to what country, which countries are benefiting, which are those that are losing, and that's a big part of the discussion in the Nordics, who is paying the bills. That's not, as I see it, the main question. The main question is what is happening to EU, and here as the topic I put is EU going federal. So is this a clear step towards EU starting to build up federal structures? Or is this just a one-time solution? And we know Angela Merkel has said it's a one-time solution, while the finance minister Olaf Scholz in Germany has said that this is the start of a more permanent structure. You can have different opinions, is it good or not that EU is becoming more federal? If that is the case, if we're going more towards more taxes, at EU level, we're going more towards financial transfers and fiscal transfers between regions, then we also need other structures. So this is not enough, then we need to take other steps as well. And especially important would be that there would be clear rules about a euro area country defaulting on its own debt, and all fears about other EU countries saving those that can't handle their own economic situation would be removed. So that would be a very important additional building block to this setup. But there's a lot of insecurity around this, but it looks as if we are going in this direction, and that would then be the other really big legacy of the COVID-19 epidemic. But as Nerijus said, the euro area has had a rough time for a long time. So it's been the pandemic, but already before that, we talked a lot about the sick man of Europe. We can talk about the whole of Europe being a sick man and an aging construction. Here's a picture of OECD recommendations. So the OECD gives economic policy recommendations every year to its member states, and then they follow up. Do they follow these recommendations? And these recommendations are usually the normal things, what should be done in a country in order to boost growth. And from this picture you can see that EU countries on average have reacted quite sluggishly to this recommendation compared to OECD average. So structural change is not happening. There are outliers, of course. You can see Estonia on the top here, but on average, not much is happening in Europe. And that, of course, comes from the political climate. It's really difficult to push through structural changes when the political situation is as torn apart as it is in especially Southern Europe, but also continental Europe. And that is very problematic, given that EU and the euro area is a very rapidly aging part of the world. That's of course not only the problem of the euro area. We just saw a picture of China also aging really fast, but it's very problematic in the euro area, where the public economy and the social part of the economy is so big. So there are a lot of expenses piling up when all these people that are now retiring in the coming decades will need services and retirement benefits and so on. And we haven't solved those problems. So we know that already over-indebted public sectors will have to take on more and more debt in order to serve its citizens, or otherwise even more unrest will come. And unrest is what we see. Insecurity is what we see. Brexit is in the headlines all the time, and that is one risk. But we also see unrest at the borders of both EU and the euro area at the moment. We see Belarus, we see conflict between Greece and a lot of pressure ongoing from Northern Africa. We have populism within our borders, almost in all euro area countries. We have right-wing populism, in some left-wing populism. We have political unrest in many countries and very difficult situations to actually push through with difficult structural reforms. We see poverty increasing in many countries and income inequality, and a lot of problems related to immigration. In some countries it's too much, in some countries too little, in some countries just the wrong kind of immigration, but a lot of tensions building up and a lot of value questions that clash within countries, but also in between countries. So the setup is not easy if we take a more 10, 20 year perspective going forward. In that perspective, the pandemic looks rather like a rather small problem. But then in order to end on a more positive note, I decided to end with the Nordics. So if you look at the euro area, it's hard to find the bright spots. But if you then compare the Nordics to the euro area, it's clear that things look better in the Nordic economies. And here's again the same picture that I started with, the effect of the pandemic on GDP developments. And here are the Nordic countries. So you can see much smaller effects than on the euro area on average, completely different scale than Italy, for instance. But what is remarkable is how similar the effect has been on the Nordic countries. You can see almost the same. Finland a little bit better, but Finland is always late in the cycle. So in the longer run, we expect the effect of the pandemic to be very similar on all Nordic countries. And that's remarkable because there's been a lot of discussions globally even about Sweden having a different lockdown strategy. And still, we see that irrespective of lockdown strategy, the economies have coped in the same way. But what is important to remember is that all Nordic countries locked down quite mildly compared to Italy, for instance. We were allowed to go shopping. Most factories stayed open, and that is the main explanation for the effect being smaller, that most people actually went to work, and we produced things also during the worst lockdowns. But other effects can come later, since all Nordic economies are small, open, and very dependent on what happens in the rest of the world. And now we are basically in wait-and-see mode, how our investment and consumption developing in the rest of the world. That will decide how the Nordics are actually coping from the whole situation. One maybe surprising fact during the crisis is how housing markets have dealt with the pandemic. In the Nordics, we saw a couple of months with a little calmer situation in the housing market, but there were no downward corrections. Here's a long picture. It's the last 50 years of house price developments. But it appears that the same developments are just going forward. So we've seen now during the past months really rapid house price increases in many regions of the Nordics. You can see Finland there being an outlier, not having increasing house prices. That it's basically explained by the fact that Finland is a late bloomer when it comes to urbanization. So Finland is now being urbanized while the rest of the Nordics was urbanized much earlier. So we see the same development in Finland in the big cities as is seen on average in the other Nordic countries. And this almost forever increasing house prices is both a reason for many to be happy, those that own housing, but also a continuous worry for policymakers that will we see a correction one day. And the worry, of course, comes from the link to indebtedness. And that is maybe the third legacy of the pandemic. If we look globally, debt is increasing. But for the moment, if you look to the right, household debt does not seem to have reacted that massively to the pandemic. It's more corporate debt and public debt. But household debt continues on an upward trend in both Norway and Finland. But as you can see, Denmark has really seen a remarkable downturn in household debt. And if you remember, Denmark had a fully fledged housing market crisis when the financial crisis hit the world economy. And after that, household debt had actually come down a lot. Denmark used to be the country with the highest household debt in the world. They are still leading that statistics, but they're coming down quite fast. And that's an encouraging sign. And as you can see, Sweden, through more regulation on that side, has also stopped the increase of household debt. So you can see that policy is really influencing these developments as well. But still the Nordics are countries where we see a lot of household debt, and that creates a vulnerable setup in combination with the increasing house prices. But on the other hand, most of the Nordics have a lot of household wealth, which makes the situation look somewhat more stable. But then we could switch to public debt, because that is really a legacy that we're not going to get away from very soon. But the Nordics are in a very fortunate situation, or were in a very good position when the pandemic started, because all other Nordics except Finland actually had very low public debt. And you can see, even if we now see a jump upwards, the levels are still going to be internationally seen very low. Finland is, to say, good European level, but still there are no big worries about the public debt increasing. But the big risk is, of course, as has been mentioned here before, that if public debt just continues to rise and rise and rise, it's going to be really difficult for policymakers to cut the expensive policy that we now get used to, and you can do magic things with a lot of public debt, and as a politician you can win a lot of votes if you continue to support the economy. So that will be one thing to follow going forward, also in the Nordics where public debt levels are low. But, and this is my last slide, overall the situation in the Nordics still look great. And this is from our Baltic Nordic report that we publish once a year, where we compare the Baltic and the Nordic countries in different ways, both with development indicators but also competitiveness indicators. And as you can see, it's yellow and it's green, mainly green for the Nordics. The Nordics are stable, reliable, competitive countries. They are still places where you want to invest and where people are happy, and where things are going in the right direction mainly. So on a global scale, the Nordics are still doing really well, but of course the same troubles as in other regions: aging, productivity growth, inequality. The same issues are present here, but on a slightly smaller scale. Thank you. That was what I was going to say. Back to you, Nerijus.
Thank you, Heidi. Oh, you were quite convincing when it comes to attractiveness of Nordic countries and their advancements in sustainable development goals. But now it's time to turn towards the Baltic countries, something closer to our home here. And for that purpose, I will ask Liiva, my colleague in Riga, who is chief economist at Swedbank in Latvia. She will enlighten us on why this crisis seems to have been somewhat milder on Baltic countries, why we have not suffered more than European Union countries on average, and is this a temporary luck, or this is going to last? Are we well positioned for further outperformance? So, Liiva, are you with us? Yes, I can see you.
Yes. Hi. Can you hear me?
I can hear you as well. That is also important.
Oh, that's good. Okay. So while we're waiting for the slides to be put up, let's see. I just wanted to highlight what I'm going to say in my 15 minutes of fame. So basically, I'm going to talk about the depth of the crisis, which Heidi already touched upon, which has been less deep in the Baltics than in perhaps elsewhere. I will speak a bit about the recovery, as well as look at the risks that are surrounding business environment in general in the world, and then see how that can create opportunities perhaps for the Baltics, and also maybe what is look at what is lacking for the Baltics to really make the most out of this future world order. So I see that the slides are up, and yes, it is happening. Let's start with a very similar graph to what you have seen already before, but this is just to highlight that the GDP fall that we have seen in the first half of the year in the Baltics has been the performance of the Baltics has been rather better than what you have seen in the rest of the world, and especially, of course, in the southern European countries. What we do see and think is that it is mostly in part due to better luck, of course, also due to quick response that we have seen from the governments that helped us to survive this this first wave with milder lockdowns, and also come out on the other side with a better performance. And if we look at how the second quarter and the first quarter has looked in all of three Baltic states, then we actually do see quite a lot of differences in between in this recovery and, well, actually in this fall in GDP. We do see that the stories are different slightly. The exports have been hurt more in Estonia rather than in Latvia and Lithuania, whereas if we look at private consumption, the differences are much larger, especially for Latvia, which seems to have in this respect suffered more. In part, perhaps it is very surprising, because technically since these restrictions have been quite similar, they have been hit by a similar way in terms of the virus, but in some aspects this is not really well somehow reflected in the statistics in exactly the same way. I mean, part of that could be because it is very challenging to make statistics during the times of crisis. So technically, we might see these results converge with time. But in general, we do also see the problems that, for example, Latvia had in 2019 that have been, you can call them pre-existing conditions, which are perhaps dragging on also in 2020 and have likely caused in lower growth in Latvia. This has to do with the transit sector, with the changes in the financial sector. Then, on the other hand, for Lithuania, we know that, well, the elections are coming, and that might be a reason why the government is more willing to spend and more willing to support the economy. It also might be the case that a re-immigration wave is helping the Lithuanian economy to perform better in this tough times. But if we look at what is happening in the latest months, we do see this roller coaster, if you will, ride in both in consumption and also in exports. And what we see from the consumption side, here I have put up the graph of Swedbank customer data, so out of cards purchases and cash out turnover. We do see that this rebound has been and recovery has been the strongest in Lithuania, and the levels are highly above the last year's levels already. Whereas for Estonia and Latvia, the consumption seems to be, well, maybe near last year's levels, which is already good, because what we saw at the worst point was a 40% drop for Lithuania and Estonia and a 20% drop for Latvia in terms of consumption, as proxied by these data. But now we are already back at the levels of the previous year, and in terms of Lithuania, even above that. So if we look at exports, the story is similar. The drop was very extensive, especially in Estonia, near 30%. But then now we do see a recovery. However, not all is still back to the previous year's levels. Especially here, I'm talking about the trade and services for Estonia and Latvia. But for Lithuania, the goods exports are also not there yet. However, this rebound is fast, which is good news for us. And the overall, this fall, which has been less than what we previously projected in our projections in May, together coupled with a really fast rebound that we see on many respects. There are, of course, other sectors which are lagging behind and are likely to lag behind for some time, but the recovery is very strong on many aspects. So what we do see is that the Baltics are projected to suffer less than the euro area in this crisis. And of course, this is good news for us to compare ourselves with others, but it is not good news for our export growth, because surely weaker trading partners are not a good sign for exports. So this would be about the general outlook that we see. And an important thing that my colleagues already mentioned is, of course, the increasing role of government in our economies and in the world as well as in the Baltics. So what we do see is, of course, that the good news for the Baltics is that the government debt has been low as compared to the rest of Europe, and we have seen strong government stimulus from our side, but the good news is that so far, at least, if this provides to be if there is no second wave which materially hinders recovery and which results in some major lockdowns, and then in that case the government debt levels that we are forecasting are not going to increase, are still going to be well below the levels of the euro area average that we have seen in 2019, and of course well below euro area average if we look at the 2020 and the years to come. So we're still looking good in that respect. And furthermore, it's not only our borrowing that we can use to finance further performance, but it is also, of course, the new European Union funds planning period that is coming with a substantial stimulus. So we have two things that are coming our way. So it's, of course, the normal usual budget that is from next year up until 2027, and then we have this recovery plan. And if we put these two things together, then the planned amount of EU funding that the economies are likely to get is almost the same as we saw in the last planning period. So if previously, before this crisis, we were talking about a decrease in EU funding that was coming, then this has well, to Latvia and Estonia, at least. For Lithuania, there is a bit of a decrease, but then this crisis has resulted in more opportunities in the sense of more EU funds available. Of course, and then there's also, in addition to this, there's also the funding for Rail Baltica, and all of that means that we will have quite a large sum of money available for investment. And that is, of course, an opportunity, but it is also a risk going forward, because this can create a much higher growth than we are projecting right now, but it is not necessarily a positive. If we compare to, for example, euro area, what we see is that the share of construction in the economy is much more volatile, and what it speaks to is the vulnerability of the economies, and actually it highlights this fact that these economies are very prone to these boom and bust cycles. So knowing this, it is of extreme importance that we plan the stimulus very carefully, especially given the fact that a large part of the stimulus is front-loaded to the coming years. So it has to be a stimulus that is not just targeted towards short-term activity boosting, but rather towards long-term growth and towards investments that improve the long-term growth trends. Of course, greener, of course, more digital, and also well-planned. And we are very worried about this aspect because this is the chance to make the most out of these investments, to really move towards a new type of economy, a greener and more digital one. The question is whether we will be ready to seize it. If we move on, then I would like you to think about what this is. And I hear someone saying that it's a scene from the movie Blade Runner. No, it is not. What it actually is of course, San Francisco at 11:15 a.m. in the morning. So this is how it looks like when you see when there is smoke over San Francisco from the Northern California wildfires. Why I'm putting this picture up here is because the pandemic brought out this is one of these risks that the majority of the population, well, it seemed improbable that we will get something like that. Whereas if we look at if we look at climate change, that it is a risk that is materializing actually in front of our eyes. And of course, it's not only this risk of climate change, it's also, of course, pandemics. Then there could be solar storms and supervolcanoes. There could be some more mundane things like cyber attacks and trade disputes that we see. But overall, the risks are large, and therefore resilience and supply chain diversification has become a hot topic recently. And I hear you say that, okay, supply chain diversification. I mean, no one has cancelled the gains from specialization. No one has kind of cancelled how large the Chinese economy is and how the country, how the businesses want to remain in near that economy. Of course, that is all true, and moving supply chains, moving production, on many respects, is very, very costly. But what McKinsey has recently calculated is that actually the disruption that can be from all these risks that have been mentioned previously, a disruption that is lasting more than 1 month, can hit businesses every 3 to 4 years, and can cost more than 40% of a year's profits every decade. So the costs of these risks are very high, which is the reason why a lot of the global exports could actually relocate in the next 5 years, at least according to McKinsey. And so rather than like a trade-off between resilience and efficiency and maybe profits, it is much more and more coming to be something that is in the long-term interests of the businesses in general to think about resilience. And why and what opportunities does that create for the Baltic economies? I mean, first of all, of course, it's just the simple fact that we are in a better position because we are in a milder climate, and that where our political situation is normally rather stable. So we are kind of a good boring destination for investment, and for investment, boring is good. So if we move to the different aspects of why the Baltics might be kind of attractive to investment, is one, of course, is labor. And labor in general in Baltics is not expensive as if you compare it to the rest of the European Union, but if you compare it to the rest of the Eastern Europe, which is as our direct competitors, then we are not looking, of course, like the best performers here. So we have to be attractive in other aspects as well. Of course, technology is limiting this importance of labor arbitrage. It's especially in this low remunerated segment. But in general, we really need to think about what else we are attractive at rather than just costs in terms of labor. And then what is the usual suspect, of course, is the quality of the workforce. It has to be well educated, and it's not just the quantity that counts. So we all know that educational attainment in all the Baltic states is high. There is a large share of population that have tertiary education. We are well versed in languages. We know many languages. That's a good thing. But then if we look at educational attainment for school children, for example, then in terms of these PISA results that OECD is doing, then we don't look that good, especially if we talk about Lithuania and perhaps also Latvia. Estonia is looking better in this respect. If we look at the digital skills of the population, which are becoming more and more important with every year, then Estonians, so the orange arrow, are looking quite good. Lithuanians a bit behind, but Latvians really have a lot of catching up to do in that respect. So the level of digital skills of the population are something that the Latvian educational system has to be working with on. If we look at the digital economy as such, then prior to the pandemic, it seems that we were quite well placed and the strength of the digital economy was the largest in Estonia, with Lithuania and Latvia lagging a bit behind. And in terms of the strengths and weaknesses of each of the countries, then we do see that digital public services are in general better in the Baltics than they are in the European Union. However, for example, when it comes to integration of technology in the business life, in Estonia and Latvia, for example, there we are lagging behind. The good news is, of course, that Corona crisis likely turbocharged this integration of tech and use of internet in our daily lives. So hopefully, this index in 2021 will look better than now. And another thing is, of course, the business environment as such. So in general, the ease of doing business is quite highly rated in all three economies, and this is of course beneficial for further investment. But what is lagging behind is government effectiveness. And given that the role of government is increasing, as we have seen from the previous presentations, and given that this is increasing, given that the government and the quality of government will become more and more important, then this is something we need to think about. So if we look at this perception of the quality of public services, of the civil service, this independence from political pressures, maybe the quality of policy formulation and implementation, all of that is kind of lagging in all three of the Baltic states. So we have there is room for improvement there. And this is the summary, but basically I will not go through all of it, but in general we are outperforming right now on many respects. The nearest future seems quite bright if we look at if we plan well, if we invest well, we can make use of all these EU funds that are available to us. And of course in the future the need for structural reforms is still there, for better education, for better and more and higher quality government is still there. So there is room for improvement as always. Thank you.
Thank you, Liva. And we have a few questions for you on Latvian consumption, but we'll get back to that at the end of all presentations. We have now the final presentation from Øystein, who is our chief economist in Norway, and he's closer to money and analyzes the credit flows. And his idea was to talk a little bit more about zero interest rate and negative interest rate environment. How come we are here? Where did this come from? And how long are we going to live with this zero interest environment? How is it likely to affect asset prices and real estate markets? Before we are waiting for Øystein to join us, and before that I would like to remind you that you have an opportunity to ask some questions which we will address after Øystein's presentation during our panel discussion. Hi Øystein, are you with us?
Hi Nerijus, I'm very happy to be with you.
We're waiting for your slides to come up, and we're looking forward to hear how long are we going to live with zero negative interest rates?
Yes. So excellent to be participating in this forum. I'm thinking about the hundreds of people that are joining us today, and that they are probably all in the same situation as I am, in a very empty room all by myself. But I'm trying to think of all of you, and very happy to be part of the of this forum. So I'm going to talk about interest rates, zero or negative, and how they impact through debt and financial markets more in general. And I now hope that you can decipher these slides, that they are readable to you. The first charts that I show here is a set of estimates that come out of the ECB. So model-based estimates of what is a normal or neutral real interest rate, so interest rates after deducting inflation. And as you can see from these charts, the zero or negative real interest rate has really become the norm according to the ECB. And it's not just the ECB that is seeing this, but also the fact that if you look at financial markets, and in this chart you see, for the same colors as the chart to the left, you see market-based measures of real interest rates. So these are based on 10-year inflation-protected government bonds. And as you can see here again, we've had already almost a decade in Europe with zero or negative interest rates, and the biggest change as of late is actually the steep decline in the United States. And so this has been going on for quite a while already, and the long-standing arguments, they include demography, they include the savings glut, and they even include questions about inequality, in the sense that as inequality rises, rich people tend to save more, and so that actually increases the amount of savings in the economy potentially. So those are the long-standing arguments, and they are unlikely to turn around very, very dramatically. But what I think is most important right now is this decline in US rates, which I think is related very much to the current pandemic and the situation on government debt. So moving to that topic, there is only one thing that you need to talk about today in order to understand financial markets. It is what is going on in US fiscal and monetary policy. This chart shows you the federal budget, with the red line being the outlays and the yellow line being the revenues. As you can see, what is going on right now is completely unprecedented. Money is being handed out in amounts never seen before to people and to businesses. And this is super, super important in terms of, the global macroeconomy, because without these outlays, then people would have, to a large extent, lost their incomes in the United States. And without these support measures, businesses would probably go bankrupt in large quantities. So these measures in the fiscal policy are absolutely key to protect the economy and keep it going for as long as the pandemic is going on. So this is key, and but what you can see there is that the difference between outlays and revenues here, the deficit is so big that it amounts to almost 20% of GDP. So this chart shows federal debt in percent of GDP. And as you can see, we were already at about 80% before the pandemic, and the projection is now that we will surpass and stay above 100%. And frankly, that is a level that we have hardly ever seen before, and certainly never seen before as an ongoing situation. So with this in mind, you can wonder, is this sustainable? How long can this last? But I think the actual question is, what does it take to make it sustainable and make it last? Because right now it is frankly very, very hard to see, the political will to, or the rationale to take government debt sharply down. In the years after the war, there was strong economic growth and many years with, let's say, moderately high inflation. And both those options seem quite far away at the moment. So instead, what happens is that the Federal Reserve is just somehow has no choice but to support this stimulus. And the way they do it is to actually purchase this debt and to keep interest rates low. So in this chart, you can see the Fed balance sheet, which you've seen on several of my colleagues' presentations here. I also show the composition of this, and as you can see, after the financial crisis, there was a big jump here in the yellow area. That's when they bought mortgage-backed securities. But this time, as you can see, the big jump is in government bonds. And the increase here in the amount of government bonds is quite similar to the amount of this year's deficit. So the central bank is very much sitting here and saying, we are the purchasers of this in the market, so that there can be no question that there is somebody to buy all this massive deficit. And on top of that, they are keeping interest rates low. And in this chart, you can see the yellow line is the nominal interest rate, and the red line is the real interest rate. And what has been happening here over summer is that the difference between these two, the measured break-even inflation, that has been quite substantially repriced. And when that happens, usually the nominal yield will follow up so as to protect investors and compensate them for higher expected inflation. But that has not been the case this time. Instead, there's a perception in the marketplace that there is a sort of a maximum amount or maximum level of the interest rate that the Fed is willing to accept. So every time the interest rate rises a little, they are out talking it down again. And the idea, quite simply, is I think that it is now so absolutely key for the Fed and for the sustainability and the effectiveness of policy that fiscal policy cannot be brought under question. There should be no questioning about the sustainability of this debt. Otherwise, it might have to change, and that would be catastrophic for the support of the economy. So what this is really telling us is that right now the roles have been changed in macroeconomic policy. It used to be the case that monetary policy was in the driving seat and fiscal policy was just going to, take care of long-term sustainability of the debt. Right now it's the complete other way around, with fiscal policy in the driving seat and central banks being trapped into supporting these fiscal measures, and quite frankly, I think trapped into keeping interest rates low, relatively low, for a very long period of time. I'm switching gears here towards the consequences of these low rates. And one of the most pervasive consequences is what is called hunt for yield. It is the incentive to go out and get better returns when the return on risk-free assets such as government debt is very low. And this is a picture from the US here, where you can see the expected real return across different types of rating categories. So let me explain to you. If you look at what is called AAA, that would be in the United States government bonds and the like. And right now they are yielding about -1%, as you just saw on the other chart. Now there is a possibility to improve on that by taking more credit risk. You could go out into what's called investment grade bonds, that is rated AA, single A, or BBB. These are the big and relatively safe firms in the sense that they are not too leveraged, not too much debt. But even there, and the incentive here to go towards this is quite big, because the interest rates on safe bonds are so low. So more and more pension funds are just quite simply almost obliged to do this, because they have a return target and there is no way to obtain that return target without taking risk. And some will even think about going towards what is called high yield bonds, which you can see could be expected to give you something like 3 to 4% return. But mind you, these are quite risky things, and regularly these firms they actually do default and go bankrupt. So not so many people will go towards that segment, but certainly many will venture into investment grade credit bonds. The situation in the euro area is very, very similar. As you can see, negative returns on what is here German-like quality of government bonds, and then moving out on the risk scale. When you look at this, you're struck by how compelling it is. Would you accept that -1 negative annual return for your savings? I think the evidence now, more and more coming out of research and empirical, is that no, people are not accepting this, and people are moving in to more risky assets. Here is one piece of evidence in favor of this. This is showing fund flows, and they are accumulated so that you can sort of see the trend. And the first one here is for United States. You can see through the latter part of or parts of last year, government bond flows were stronger, so money was still flowing into government bonds at large scale, and that happened up until the crisis, where people were looking for something very safe. But after that, there's been a massive, massive rebound and huge inflows into corporate bonds, which is precisely what the preceding argument was. And here is the picture on for Europe. As you can see here, through last year, government bond flows were not as strong as corporate bond flows. That, I think, is quite simply related to the fact that we've had these very, very low interest rates in the euro area for quite some time now. So people have already for quite a while moved into corporate bonds. And then the crisis and then the rebound. And as you can see, you can imagine, obviously, the world is a much less safe place now than it was a year ago. But in spite of those risks that have undoubtedly risen, the temptation and almost the requirements of many fund managers is to move towards more risk. Now, all of this might sound almost perverse, but you know, this hunt for yield is actually an intended consequence of the central bank policies that we have. And why is that? I'm going to show you one example. This chart is, again, data for the US. We're looking at the corporations in the BBB segment, and what you are seeing is that the top line is the total borrowing costs, so how many % they have to pay in financial markets to for their bonds, so that financing in bond market. And the lower line, that is the sovereign rate, so the rate on government bonds. And the difference between the two is the credit spread, so how much more the corporations have to pay than the sovereign. And as you can see, sovereign rate falling, that sort of helps on financing costs for businesses. But when we go into crisis and uncertain times like we've been through this year, the credit spread will easily increase by much more than what the sovereign rate falls by, so thus increasing borrowing costs. And this is why the hunt for yield is in many ways, it's a desired and intended consequence of central bank policy, because you have to get this money flowing in order to make sure that total borrowing costs comes down. And when we switch to look at the euro area, which is on this chart, you can see that effect on credit spreads actually becomes even more important, because here the sovereign rate was already low before the crisis. There wasn't much more it could fall. It is effectively at a lower bound. So when you get into the crisis, there is little help from direct help from the low interest rate. What you need is to get funds flowing and people to start buying up corporate debt. So far, what do we have? Negative interest rates being trapped in, perhaps due to the central bank and due to government debt. The solution to debt is more debt. And moving on to the corporate market, again, there has been a massive need to get funding for corporations through the pandemic, because they've lost sales and profits have fallen. What is the solution? It is more debt. Is it encouraged by the authorities? Yes, it is. It sounds perverse, but we are really living in a world where, to a larger and larger extent, we are dependent on debt, and dependent on debt not becoming too expensive, and all measures are used for this purpose. One of the things that people worry about in terms of low interest rates is bubbles in the stock market. I'm actually not too worried about this. And to show you why, I think bubbles, they appear in stock markets every now and then, and we might have one right now, but it has more to do with information technology and how people think about that than I think it has to do with low interest rates. So in this chart, you can see the information technology sector in the US. This is from the S&P 500, but you can also see the value of the other types of stocks. Now, information technology has become really a big sector, covering about 25% of the whole index, so it is really driving much of the market up and down. But as you can see, that the discrepancy between the two has been massive this year. So if there is somewhere to look for a bubble, I think it is in the information technology sector, and not so much in all the other sectors. And to emphasize that point, I'm going to show you another chart which shows the price to earnings ratio for different sectors. So price to earnings ratio is interesting here because it provides a measure, not perfect, but some measure of how much you have to pay for a given level of profits. And as you can see here, in the information technology sector, that ratio has risen dramatically. So actually in the sector, the profits have not really changed much. What has changed is how much people are willing to pay for them. And this, to many, is, using the PE is quite a good measure of thinking about stock market bubbles. And this is, as you can see, in quite sharp contrast to other more normal sectors such as utilities, financials, healthcare, and consumer staples, where there has been a rise, but not a lot. So I think all this goes to saying that if you are very worried about low interest rates, then you shouldn't so much look to the stock market, because the risk premia are so big that the interest rate, the impact of an interest rate change is not very big. Where you should go and look, I think, is where the risk premia are small, because there a change in interest rates will have a big impact on your overall discount factor. And in my opinion, that area and that place where you should be most worried is in the housing market. So I'm showing you here a picture of house prices across 3 Nordic capitals. And I'm sorry to not have included the Baltics here, but I must say I don't feel confident in talking about the Baltics. I'll leave that to my other colleagues. But what I know quite a lot about is the impact that and the developments of house prices across the Nordic countries. And here we start the index in 2010, but as you can see, over a 7-year period from 10 to 17, Oslo prices doubled. Stockholm prices did about the same, and Copenhagen managed 70%, which is also not bad in an economy where you have 2 to 3% wage growth. That means that people are paying more and more in terms of prices for housing than they have in income. And the only reason that this was possible was credit. So credit is essential for all parts of our economy, and in the housing market that is for sure the case, at least in the Nordic countries, where credit has been quite free. And if you don't believe that credit is driving house prices, you can take a look at this chart, which shows a correlation between credit growth and house price growth for Sweden over the past 10, 15 to 20 years. And as you can see, these things go hand in hand, and that's not very complicated to understand, because essentially nobody in these countries buy a house without taking on a mortgage. So mortgages are enabling house purchases. And what has been the outcome of this? So why do I worry about this? I worry because I think the story here is reasonably successful economies and cities together with too low interest rates and a relatively liberal system of credit. And that has driven all of this up, and it is becoming more and more a problem of inequality, precisely because living in these cities or purchasing something in these cities is now beyond the scope of more and more people. And it became a macro problem that this was coming out of control, and the way they solved the macro problems was by restraining credit. So in all other areas we have authorities encouraging credit at the moment, but in the area of house prices, the situation is different. There's been regulations of debt to income and loan to value, and in all these countries, and it's in all these countries credit restrictions that explains why things have stabilized. So, and this is a double-edged sword, because it is in many ways good for macro stability that house prices have been more stable, but it is not improving things on the inequality front, because prices are now stuck at high levels and people and not everybody can borrow. So I think we are looking at something that is, a malaise in the global economy, which is large and rising inequality, and it is also coming to some of the Nordic countries. And I hope you will find good ways to solve this in the Baltics, because with so low interest rates and relatively successful economies as you have, you should have quite a big potential to run into this problem. So I'm summarizing very quickly on what I have said. Negative real interest rates have become the norm, and central banks have, to a large extent, no choice but to support this situation, thus trapping in low rates for longer. That is not to say that rates cannot rise at all, but I think they will, if they rise very moderately. On the financial consequences, the hunt for yield, and you see it is working. Funds are flowing into corporate credit, and credit spreads have declined materially. There may be bubbles in stock markets, but I don't think they are directly related to interest rates. I think that the risks on interest rates are more to be seen in house prices. And to solve this, mortgage credit restrictions have become widespread, but that only means that housing is already adding to a big problem with rising inequality. As a bottom line, I think it's fair to say that we are seeing now bigger and bigger challenges for fiscal policy and structural policy. This is about fiscal policy because monetary policy has become less effective. It is also a lot about structural policy because that is probably what is needed to solve inequality in the housing market or even in income on the income side. And all of this has a potential to succeed, but it also has a big risk because whenever you are looking at fiscal and structural policy, they are not always guided by what is best for the economy, but guided by many other things that enter into the political equation. And frankly, with more emphasis and more challenges for these areas, I also see bigger risks ahead for policy failures. That was all from my side, Nerijus.
A short panel discussion or more of a question and answer round. So I ask Øystein and Liva and Andreas and Heidi to come here virtually in one room. I can see you now, which is fantastic. We have quite a few questions and we will not be able to answer them all, but since we are a bit ahead of the schedule, but some of the questions are of course very relevant and interesting. So I will continue on Øystein's presentation, and I think this is the question which is, you partially answered that during your presentation, but I think this is on all our heads, how this stimulus can end. And you said that central banks are basically trapped with these current levels of debt. It's very difficult to raise interest rates, and probably that's one of the reasons why what has Andreas mentioned is that Fed is moving to targeting average inflation, meaning allowing prices to run away or even wanting prices to run away. This is probably going to happen in Europe as well. ECB is going to change its target during the next half year or so. So do you see any way out of this massive stimulus, which was probably unimaginable just a couple of decades ago? And a follow-up question, which is partially related and probably more difficult to answer, is where do you see euro-dollar exchange rate in the future?
Yeah, thank you. I think the question of how to get out of the massive stimulus is probably medical. And I'm actually quite optimistic about the development of an effective vaccine or several effective vaccines. And I think as looking at how fast progress has been in this area, I think it is actually quite fairly likely. I'm expecting to see a rollout of vaccines on a massive scale in the global economy next year. And I think as that happens, we're likely to get back to a high level of normalcy. Some things have changed permanently, and maybe we will continue to do digital conferences also in the future to avoid traveling and polluting so much for the environment, but I do hope that we will meet, though. But most things will actually return quite to normal, and I think that is certainly the case for stimulus and the deficit. So we'll manage to get back to a more stable level of government debt. My worry is that that level will be so high that it will be very, very hard to raise interest rates.
Yeah. How about the euro dollar?
Well, so there are so many factors that go into this. I actually believe that one of the key drivers here is going to be about relative inflation. And potentially we could have now a situation where US inflation, for many of the reasons that Andreas mentioned, could substantially overshoot. I'm not saying I know it will do, but it could substantially overshoot, and especially relative to what you see in the euro area. And that, I think, has been somehow forgotten, that we are looking a lot of the times at nominal exchange rate, but we should look at real exchange rate, and we could have a substantial weakening of the dollar ahead of us if that comes true.
Yeah. Thank you, Øystein. And following up on the inflation, we have quite a few people asking us about this inflation and how soon could it emerge? Is it unavoidable? And especially not only in the housing market. Obviously, in the housing market, in quite a few countries, we already see that people and maybe others also trying to hedge their risks, their potential loss of purchasing power by investing in real estate. But could it be a more widespread phenomenon? And I know, Andreas, that you are not so worried about inflation. We had quite a few discussions. I laid out the arguments for the inflation. You see quite some other counter-arguments. So what would be your take here? Is the risk of inflation really substantial, or it's going to be just mildly higher price increases going forward?
I think first we have to be clear that to differ on actual asset prices and consumer prices, right? So I do think that asset prices will probably continue to rise in this low interest environment. That said, on consumer prices, I think that there are, economists are divided here, and my take on that would be that I think also when we look back, we move forward a few years, also that world will be very competitive. We will have a large trade in internationalization. We will be even more digitalized, which means implies high competition. And that somehow would put a ceiling on inflation and cost pressures. So that I think is the most important factors that will hold back consumer price inflation.
Yeah. Andreas, we have a question on to Liva on developments in Baltic countries. So, and that is so interesting for myself. What are you going to answer to this question? We had somewhat milder lockdowns in Latvia. As far as I know, you didn't close shopping centers or most of the places where you provided services. But if you look now, and one of the slides that you have shown is that household consumption in Latvia has actually declined more than in other Baltic countries. So is this some sort of statistical peculiarity, or is there an answer why with milder lockdowns you had still rather large decrease in consumption? And related question is why Estonian exports have actually suffered more than in the other two Baltic countries.
Nerijus, can I ask before Liva, I'm really sorry, but I have to leave this panel now. We're running a bit late on time. So I'm just saying, very happy to see you all, and good luck with the panel and so forth. So just saying goodbye.
With us, yes.
Cheers.
Okay, Liva.
Okay, so yes, it is a great question, and I would like to know the answer as well, because actually when we look at other short-term indicators like retail trade or even these Swedbank card transactions data, we actually don't see the same magnitude of difference. I mean, there are some differences, but that doesn't entirely explain what we see in these national accounts data. So on the one hand, yes, I would say that perhaps there is a bit of an issue also with collecting statistics during this time. So perhaps with time we will see that being corrected. Another thing is that perhaps because of these milder lockdowns that Latvians experienced, then maybe what the Lithuanians and Estonians were more keen to go out and kind of consume, and rather than Latvians, because they had been always, allowed to go to a restaurant or something. So perhaps this change in the what they are allowed and what they're not allowed to do, then perhaps that resulted in some faster rebound in consumption. But also, maybe it's worth mentioning that, for example, if we look at the situation before the crisis, then this consumer sentiment in Lithuania was much stronger than what we saw in Latvia and in Estonia, and also consumer sentiment in Lithuania rebounded very strongly after the fall during the very toughest crisis months. Then it rebounded soon as well. So perhaps Lithuanians are just more optimistic in general on life, so maybe that helps as well. But to be honest, if I'm totally serious, then it is tough to explain this. It is tough to fully explain it, especially if we look at wages, different indicators that are not showing this large difference. Yeah.
The number of times that I have been called optimist since May, when we had rather mild forecasts for Lithuanian GDP is large, and finally a lot of forecasts are catching up, and we are no longer called optimists. We are finally realists, something that we have always been. And I think when it comes to Estonian exports, one of the reasons, of course, the structure and components of exports. I think why Lithuania and to some extent Latvia was relatively less hurt, because we were producing a lot of food products, furniture, fertilizers, something that was in a strong demand even during the pandemic and quarantine, whereas Estonia produces more, sometimes higher value-added electronics and components, which may have suffered, its demand has suffered in the short term. Shale oil production of it also could have been one of the factors why its exports have contracted more, at least in a short term. Since we are running out of time and Andreas already left us, I have the final question to all three of you. And we've heard quite a few risks being mentioned here today, a wide plethora of risks. So I want you to pinpoint one risk that you think is going to be the most relevant during the next 12 months, something that may possibly surprise and upset us here in the Baltic and Nordic region. And Heidi, can you start with that?
Well, I'm most worried about that this pandemic, despite all support measures, will lead to some form of financial crisis, taking on hold in the euro area, and in that sense then affecting also the Nordic and Baltic regions, even though it would only be indirectly.
Okay. Liva?
For me, I think what doesn't let me sleep at night is still Brexit, which is very much topical and has become even more topical. And we are seeing that the issues that there are happening right now with the agreement, and whether it will be actually whether the countries will come to an agreement at all, is under a big question right now, and which could of course result in a lot of chaos and uncertainty especially at the start of next year. So this is something that will not help the economy at all, and it will really be another drag on growth.
Okay, thank you. Øystein?
Yes, as I mentioned in my presentation, there's a lot more emphasis now on politics and on fiscal policy in particular, and so I actually think that the biggest risks right now